When it comes to investing in value or high quality businesses, we have to start somewhere. And for many investors, especially those that place a premium on the fundamentals, that somewhere is historical performance. And more specifically, how has a business grown year by year in some important metrics? What can we learn from a potential investment by how it has grown its revenue or earnings per share over time? Welcome to the Quality Investor. On today's video, I want to cover a basic yet foundationally important concept about investing. But I want to take this concept one step further. I want to assess historical growth trends in certain key areas of the business. If you look at a visual that charts yearly growth in revenue, you'll quickly notice that growth is erratic. In some years, a business can grow revenue by 20%, only to follow that with a decline of 5% and then post 7% revenue growth the year after that. Well, there is a handy concept to smooth out these erratic growth spurts and fits. That concept is the compound annual growth rate, or CAGR for short. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. CAGR is an incredibly useful way to smooth out the lumpiness we see in business metrics. It provides the annualized growth rate of investment metrics over time. It takes that 20% growth in year one, negative 5% growth in year two, and 7% growth in year three, and gives you a nice smooth growth rate in a single number. In the example data set I just provided, that would be a 3-year CAGR of 6.8%. The beauty of CAGR is it standardizes annual growth for businesses and makes it easy to compare performance over time and across businesses. It provides a baseline for investors to extrapolate future growth, giving us an anchor against wildly optimistic growth assumptions. If Coca-Cola's revenue has grown 6% annually the last 5 years, it doesn't make any sense to assume future growth of 20%. But CAGR has some limitations as well. And that is the step further I want to go today. Remember my example of 20% in year one, negative 5% in year two, and 7% in year three? Well, the CAGR was 6.8%, which isn't bad, but that growth is pretty erratic. In fact, if I saw a business like that, my first concern would be that this is an unpredictable business. And on the Quality Investor, one requirement of our investing is businesses that grow in a predictable fashion. Predictability is one of the factors that lead to compound returns over time. A business with erratic growth will have erratic returns. The market may favor it one day, and it will quickly be out of favor the next. What I will dive into today is CAGR of a few important metrics, but also the volatility of that CAGR. A 10% CAGR for one business can be very different than a 10% CAGR of another business. And by assessing this volatility, as well as finding years where growth was actually negative, we can get a much better picture of the business we are eyeing as a potential investment for our portfolio. I hope you find this discussion insightful for your own investing to help in making intelligent decisions for high quality investments. What are we looking at here? I have a chart here, and one of these columns is metric volatility. Currently, the metric I'm looking at is revenue. And I have it filtered for the S&P 500 businesses, and the 10-year CAGR percent, or the growth rate for revenue over the last 10 years, the CAGR is above 10%. So all of these businesses achieved above a 10% growth rate for their CAGR. So what is this metric volatility? Well, we're looking now at Coterra Energy. They have a 10-year revenue CAGR of nearly 13%, which is very good. But their metric volatility is at nearly 67%. Now, this volatility metric is actually a simple standard deviation. So it's a standard deviation of each yearly growth rate for that revenue. And you can see here, it's actually very choppy. They had 24% growth in one year, negative 37% in the next year, 52.6% one year, 162% growth, then negative 35%. And you can see that volatility in their fiscal year revenue here. Sure, over 10 years, it technically trends upward, but you're definitely getting a lot of variation in that revenue growth. The other thing I'm showing here is consecutive years growth. So this business has actually reset its consecutive year growth. But the larger this metric volatility here, the more up and down this year-over-year revenue growth line is going to be. And this green line is measuring what their 10-year CAGR is. So you can see that smoothed out number here, but their year-over-year revenue growth is nowhere near that number. Let's look at Cigna Group, their healthcare sector, and their competitor to one of my holdings, United Health Group. They have 14 consecutive years of revenue growth. Their 10-year CAGR here is nearly 20%, very good, yet they have pretty high volatility at nearly 63%. The reason is you can see that while they've had pretty consistent growth year after year, over the last 10 years, they had one giant pop in fiscal year 2019. That was actually an acquisition of Express Scripts, Cigna's PBM or Pharmacy Benefit Manager arm, back in fiscal year 2019. And you can see that big revenue jump occurring that same year. So while they've had good revenue growth, it was aided by an acquisition which caused a little bit of volatility. But you can see over time, it's actually been very stable, slow growth if you actually look in to the numbers. This 20% could be a little misleading. What about the other end of the equation? Companies that have a very low metric volatility or a very low standard deviation in their revenue growth year over year. Well, here I've selected MSCI, one of my favorite holdings, by the way. A very low metric volatility of 3.68%. They have a 10-year CAGR of 10.7% and 11 consecutive years of revenue growth. And you can see here that year by year, their revenue growth is remarkably consistent. There's no big jumps. There's no years with negative growth. And it's led to a very smooth revenue trend line over time. United Health, another one, that competitor to Cigna. They've had 22 consecutive years of revenue growth. They also have very low volatility, and you can see that reflected here in that line. Not a lot of variance year over year between their revenue growth. So this is one thing I'd like to look at right away. Their 10-year CAGR for revenue growth has to be at least 10%, but not all 10% CAGRs are created equal, as you see. And you look at some of my holdings here, all in green, are all very low volatility. Visa, low volatility. Microsoft, low volatility. Adobe, low volatility. That means they're all predictable businesses. Even Amazon, which has a lot of volatility in free cash flow, but revenue-wise, Amazon grows very predictably. And that's what we want to see here on the Quality Investor, that predictable revenue growth over time. And one way to assess a predictable business is to see how volatile their revenue streams really are. Let's look at metric volatility for free cash flow. Another very important metric in terms of how we're going to value businesses over time. Of course, on the Quality Investor, we want businesses that generate a lot of free cash flow, and we want to see that free cash flow growing over time. Now, the most volatile one here on this list, this is again, companies that have achieved 10% CAGR in their free cash flow over the last 10 years. And the most volatile one on this list is, of course, Tesla, which I do own. Tesla has a bit of an outlier in their first year of data here. They had a decline here in their fiscal year growth of over 177,000%, which then still very erratic the rest of the way. But Tesla's just not a good example here. But one thing you can notice right away is that free cash flow is far more volatile than revenue. Caesars Entertainment, for example, has a lot of volatility in their free cash flow. And why shouldn't they? They had one big year here where they had a huge drop. Of course, that was the COVID year. They're an entertainment business. Netflix has just recently became free cash flow positive. So you're going to see some volatility here. And of course, any business that's going to be in the energy sector, they're going to be volatile in revenue and in free cash flow. Very tied to commodity prices. And ExxonMobil, of course, is no exception. Of course, there are plenty of businesses that have very low volatility in their free cash flow. These are the compounders. Accenture, the lowest on this list of above 10% CAGR free cash flow companies. And you can see here very consistent free cash flow growth over the last 10 years. They had a bit of a dip here in fiscal year 2024, but otherwise growing free cash flow. Salesforce has had 10 consecutive years of free cash flow growth. Very stable. This is a predictable business. Cadence, a business that I really, really like, yet I think is a little bit high right now. Also, very predictable. And you can see that solid free cash flow growth that they have. Of course, the ones that I own here, Microsoft, Fortinet, United Health, even Microchip Technology, which has been on a bit of a downswing recently, has seen very consistent free cash flow growth. And my most recent holding, Intuit, also fairly consistent. So free cash flow growth, of course, is going to be a little bit more erratic than revenue growth, but you can still find quality, predictable businesses with low volatility in their free cash flow that you know will compound year after year and give you a good return over time. So this is one more trick to look at when you're trying to find high quality, predictable businesses. Park your money for the long term and to reap those compound returns over time. For example, with Arista Networks, a 63.9% compound annual growth rate for free cash flow definitely stands out, but you can see there's a lot of variability in that free cash flow. It makes it that much harder to predict over time. Even Broadcom, an investment darling, one I sometimes wish I had got in on a while back, it's had very good 10-year free cash flow growth, but what can we see here? That free cash flow growth has slowed significantly. Broadcom is flirting with a $1 trillion valuation. It's going to be tough for this business to get back to these types of free cash flow growth rates. Of course, I do believe they're going to grow their free cash flow, but it's good to see if it's slowing over time, how erratic that free cash flow is, or how predictable, how consistent is that free cash flow growth. And this is just another tool to see that. I hope you enjoyed this presentation and helped make it a little bit easier for you to find high quality, predictable businesses in the market. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.